Welcome back to the Pro Ticker Podcast, everyone. Your Friday morning edition covering major financial magazine headlines. It is Friday, March 28th, 2025. And wow, do we have an interesting set of articles and data to unpack today. We're going to try to really make sense of what all the big financial publications are highlighting and more importantly, what does it all mean for you as an investor? So we're seeing a lot of focus right now on potential new tariffs, some key inflation numbers, both here and in Europe, and a few surprising shifts in how investors seem to be approaching the market. We'll be drawing from sources like MarketWatch, Bloomberg, and the Wall Street Journal today to give you that comprehensive overview.
So, yeah, sounds like a lot to cover.
Yeah, let's just jump right in.
Okay, let's unpack this.
All right, so tariffs. This is kind of the big one. Right now, it seems like it's casting a long shadow over a lot of the economic discussion right now. And we're seeing these concerns about President Trump's planned reciprocal tariffs popping up everywhere, like we see in MarketWatch. We see Bloomberg's coverage of global bonds and the stock market, and even in the Wall Street Journal's reporting on copper.
Mm-hmm.
The underlying worry, it seems, is that these tariffs could really stoke inflation and put the brakes on global economic growth.
Mm-hmm.
And Bloomberg mentioned that we could see these tariffs announced around April 2nd.
Yeah, I saw that as well. That timeline really puts a sharp point on it, doesn't it? Like when you think, okay, April 2nd is coming up pretty quickly,
yeah,
and businesses need time to adjust.
Exactly. And speaking of businesses and how they're reacting to this, the comments by Tom Barkin, president of the Richmond Federal Reserve, really stand out to me. He was quoted in MarketWatch talking about businesses being almost frozen or paralyzed by the rapid fire changes coming out of Washington. He said it's not just tariffs, right? It's also immigration, taxes, regulation, the size of government. All these things are changing so rapidly that it creates this sense of a fog.
Oh, that's a great analogy.
It really is.
You can't plan for the future if you can't see what's coming.
Yeah, you don't know what to expect, so you just kind of have to wait.
Exactly.
And he really drove that point home with this really vivid analogy. He said it's like driving in zero visibility.
Yeah.
You have to pull over and turn on your hazards and just wait.
Wow.
And this fog, it's not just impacting businesses, right? It's also impacting consumers.
Of course. Yeah. It makes people hesitant to spend, if they're not sure what their job security is going to look like or how much things are going to cost in a few months, they're going to hold back.
Right, exactly. And it sounds like it's also making it difficult for the Fed to determine their next steps on interest rates.
Yeah.
Until this fog lifts.
Yeah, makes sense. The Fed relies on clear economic signals to guide their policy decisions, right? So if the economy is shrouded in fog, it's going to be much harder for them to make those decisions.
It is. And we also have, the president of the Federal Reserve Bank of Boston, Susan Collins.
Mm-hmm.
She was quoted in Bloomberg saying that she's also worried that these tariffs will lead to near-term price pressures.
Yeah. I mean, that's the big fear, right? That this is all going to translate into higher prices for consumers.
Exactly. And we're already seeing some reactions in the commodity markets, which, as you know, are often kind of an early indicator of these things.
Yeah.
Both the Wall Street Journal and Bloomberg noted that copper prices on the London Metal Exchange have fallen for 3 consecutive days now on the back of this tariff news.
Mm-hmm.
And then the Wall Street Journal pointed out an interesting detail. The spread between the London Metal Exchange and COMEX copper contracts is widening.
Okay.
Which suggests that traders are trying to import copper before these potential tariffs kick in.
So it's like they're trying to get ahead of the curve.
Yeah, they're trying to stock up before prices potentially go up.
Exactly.
So, for industries that rely on copper, this could mean some short-term price volatility.
For sure.
And what's fascinating is that these concerns aren't just limited to the U.S., right? This is rippling out internationally.
Oh, yeah. Globalization in action.
Yeah. Bloomberg highlighted a report from Pictet Asset Management. They're taking a more cautious stance on emerging markets because of these growing U.S. tariff worries. And their increased bearishness on exporters like Mexico really underscores the global interconnectedness of these trade policies.
Yeah, I mean, think about it. Mexico sends a lot of goods to the U.S., right? Yeah. So if those goods are suddenly hit with tariffs, it's going to hurt their economy.
Right. And it's going to impact, investors who have money in those markets.
Exactly. And this is what Valerie Geenan at Barclays Private Bank Monaco was talking about. She was quoted in Bloomberg saying that these tariffs seem to have lose-lose implications for all parties involved.
It's not just one country or one sector that's likely to bear the brunt.
Right, everyone's interconnected.
Exactly. And if we connect this back to the broader economic growth picture, Bloomberg's report on U.S. economic growth mentioned that some forecasters are anticipating slower growth for 2025,
Yeah, I saw that too.
with even a possibility of a GDP contraction in the first quarter.
Oh, wow.
Part of this could be attributed to a surge in imports as businesses try to get ahead of these tariffs, followed by a potential lull.
Right, so like a short-term boost followed by a slowdown.
Exactly.
Right.
So, for you, the listener, this could translate into a more uneven economic landscape in the coming months.
It's like we're on this economic roller coaster.
Yeah, with potential for some stronger growth in the very near term, followed by a slowdown.
Buckle up.
All right, so let's switch gears a little bit. Let's talk about inflation.
Okay.
We did get some encouraging news out of Europe this week, according to Bloomberg. Inflation in France unexpectedly held steady at a low 0.9%.
Okay.
And in Spain, it actually slowed to 2.2%.
That's good news, right?
That's good news. Both of these numbers are below the European Central Bank's 2% target.
Yeah, so they have a little more breathing room now
They do.
to maybe cut interest rates and try to stimulate the economy.
Exactly. And as Bloomberg noted, money markets have already increased their bets on ECB rate cuts this year.
They're anticipating action.
They are. So, for those of you following global monetary policy, this is definitely a key development to watch.
Absolutely.
Now, turning back to the U.S., all eyes are on the upcoming Core Personal Consumption Expenditures Price Index, or PCE as it's often called. The Wall Street Journal, MarketWatch, Bloomberg, they've all pointed out that this is the Federal Reserve's preferred inflation gauge.
It's the one they watch most closely.
It is because it strips out the more volatile food and energy prices.
Right, so you get a clearer picture of underlying inflation.
Exactly. And the expectation, according to all these sources, is for a 0.3% rise in February, which matches the pace we saw in January.
Okay, so steady,
Steady.
but not necessarily declining.
Right. And interestingly, Bloomberg's report on U.S. economic growth also mentioned that the prior estimate for Q4 GDP's core PCE was revised down to 2.6%.
That's interesting.
It is.
So maybe inflation is moderating a little more than we thought?
Maybe so.
It's like a little glimmer of hope
A little glimmer of hope.
in the inflation fight.
Yeah. And Bloomberg reported that global bonds actually rallied on the back of this softer European inflation data. And as investors are now awaiting the U.S. PCE numbers, we also saw Treasury yields retreat, which is often seen as a sign that the market is anticipating potentially less aggressive monetary policy from the Fed.
It's like the market is breathing a sigh of relief.
Yeah, they're thinking maybe the Fed won't have to raise rates as much or as quickly as we thought.
Exactly.
And it seems like the money markets are on the same page here. Bloomberg noted in their coverage of both global bonds and the stock market that there's been an increase in bets on Federal Reserve rate cuts this week.
So the combination of that softer European inflation and the downward revision to the U.S. PCE data is definitely fueling speculation about potential interest rate cuts on both sides of the Atlantic.
It is.
This is a great example of how global economic data can influence market expectations for central bank actions.
It really is. And, for the average listener, this can impact everything from mortgage rates to the returns on their fixed income investments.
Absolutely. It's
Yeah.
all connected.
All right, let's shift gears again and talk about investor sentiment and some interesting dynamics that we're seeing in the market.
Okay.
Jim Paulson, in his Paulson Perspectives blog, he pointed out that the correlation between S&P 500 stocks is currently near a two-decade low.
Now, what does that actually tell us?
So for those of us who don't track this kind of thing every day, what this means is when stocks are highly correlated, they tend to move together,
Right.
suggesting that, broad market trends are driving performance. But when they're less correlated like they are now, it implies that individual company or sector-specific factors are having a greater influence.
Okay, so more individual stock picking opportunities.
Potentially, yeah. And, historically, as Paulson argues, a low correlation among S&P 500 stocks has often been a signal of lower overall market returns and potentially higher individual stock risk.
So more risk, more reward.
Potentially.
Yeah.
Yeah, MarketWatch even noted that 6 of the last 8 bear markets occurred when this correlation was below average.
So it's something to keep an eye on for sure.
It is, and Paulson offers a few potential explanations for this low correlation right now. He mentions negative money supply growth, an inverted yield curve, which, can be a sign of economic uncertainty,
Right.
and the Fed's current tighter monetary policy. But he also has a fascinating point. He suggests that perhaps investors aren't as pessimistic as some of the sentiment surveys might indicate.
It's like their actions are speaking louder than their words.
Exactly. It's like their actual trading behavior is telling a slightly more nuanced story than the responses in surveys.
Maybe they're selectively optimistic.
Right.
Like they see opportunities in certain areas but remain cautious about the broader market.
Right, and this month hasn't exactly been a banner one for the S&P 500. Both MarketWatch and Bloomberg report it's on track for its worst month since September 2023.
Oof.
And a big part of that seems to be this ongoing tariff uncertainty and concerns about whether some of these high-flying AI companies might be overvalued. Bloomberg even pointed out that the S&P 500 is heading for its worst quarterly performance since 2023, down around 3.2% in the first quarter.
So rough start to the year.
And we're also seeing a pretty significant split between value and growth stocks.
Yeah.
The S&P 500 Value Index is actually up slightly this year, while the S&P 500 Growth Index has seen a notable decline. And Bloomberg noted that this is the value gauge's best quarterly run against growth since the market downturn in 2022.
So value is back in style.
It seems so, at least for now.
It's like a pendulum swinging back and forth.
Yeah, but it's interesting, though, because even with this shift towards value stocks, analysts are actually expecting earnings for value companies to fall,
Oh, really?
while they're anticipating a jump in earnings for growth companies.
So it's a bit of a paradox.
It is.
Investors are flocking to value even though the earnings outlook isn't as strong.
It seems that way. It seems like right now investors are prioritizing perceived safety and lower valuations.
Right. That flight to safety we were talking about.
Exactly.
When there's a lot of uncertainty in the air, investors often prioritize preserving capital over chasing potentially higher growth.
They're willing to accept lower expected earnings for the comfort of perceived lower risk.
Makes sense.
But, the longer-term sustainability of this trend is going to depend on whether these value companies can actually deliver stronger earnings to justify their valuations.
Right. They need to prove themselves.
Exactly.
Otherwise, this could just be a temporary blip.
And speaking of individual companies, the situation with NVIDIA, as reported by MarketWatch, is quite compelling.
Oh, yeah. What's going on there?
So their stock price has fallen considerably to the point where some analysts actually see it as undervalued.
Okay.
Yet the stock continues to decline.
So what's driving that?
It seems like there's a couple of factors at play. MarketWatch suggests that there's ongoing investor bearishness towards AI stocks more broadly.
Right. There's that fear that the AI bubble might be bursting.
Yeah, and there's also worries about geopolitical issues like
Yeah.
potential regulations on AI technology diffusion and possible Chinese import restrictions.
So it's a combination of factors.
It is, and adding to the negative sentiment, the death cross pattern recently appeared on NVIDIA's stock chart.
Oh, no. The dreaded death cross.
For those not familiar with technical analysis, a death cross is when a stock's short-term moving average crosses below its long-term moving average. And it's often seen as a bearish signal.
So not a good sign for NVIDIA.
Not a good sign. And, the NVIDIA situation really encapsulates the challenges of investing in a rapidly evolving sector amidst geopolitical uncertainties.
For sure, even if the underlying technology and the long-term potential of a company are strong,
Right.
short-term market sentiment and these external risks can really weigh down the stock price.
They can.
And then when you throw in something like a death cross, it can further amplify that negative sentiment and potentially trigger more selling.
All right, so now let's touch on this wealth effect theory that Oxford Economics discussed in MarketWatch.
Okay. The wealth effect.
They argue that changes in our financial wealth, increasingly tied to the stock market, have a significant impact on consumer confidence and ultimately how much people spend. Their analysis suggests that for every 1% change in financial wealth, personal consumption expenditures move by about 0.14%.
So even small changes in the market can have a ripple effect.
They can, and this is a really important concept because it highlights how interconnected the financial markets and the real economy have become.
Right. What happens on Wall Street doesn't stay on Wall Street.
It doesn't, and as Oxford Economics pointed out, the wealth tied to the stock market now actually has a greater influence on consumer behavior than housing wealth.
Wow, that's a big shift.
It is. It used to be that housing wealth was the dominant factor, but now it's the stock market.
So the stock market is really driving the economy now.
It seems that way. And this means that even if you're not a direct investor in the stock market, its performance can still indirectly impact your spending power.
Yeah, and the broader economic outlook.
And the potential downside here, as MarketWatch notes, is that a significant downturn in the stock market could really dampen discretionary spending.
If people see their portfolio shrinking, they're going to tighten their belts.
They're going to be more cautious with their spending on non-essential items, which can then have a ripple effect across the economy.
It's a domino effect.
Yeah, negative market performance leads to lower consumer confidence, reduced spending, which further weakens economic growth.
And potentially leads to further market declines.
It's a vicious cycle.
It can be.
But on a slightly more positive note, Bloomberg's report on U.S. economic growth in the fourth quarter showed a 2.4% annualized rate.
Oh, okay.
And, perhaps more encouragingly, corporate profits jumped by a robust 5.9%, which is the biggest increase in over 2 years.
So businesses are doing well.
They are, which suggests that they might have some buffer to absorb potential tariff costs without immediately passing them on to consumers.
That's good news.
It's a silver lining.
At least in the short term.
Exactly.
But, the extent to which companies can absorb these costs is going to depend on the size and duration of the tariffs
Right.
and the overall strength of consumer demand.
Exactly. So we'll have to wait and see how it all plays out. We also saw a few other interesting headlines this week.
Okay, like what?
Lululemon Athletica stock took a significant hit in pre-market trading after delivering a disappointing outlook.
Oh, that's not good for them.
It's not, and this could signal some concerns about consumer spending in a particular sector.
Yeah, maybe people are cutting back on their athleisure purchases.
Maybe. And then on the flip side, we saw gold prices continue their recent upward trend, hitting a fresh record high, around $3,080 an ounce.
Wow, gold is on fire.
It is. And this move was likely fueled by investors seeking safe haven assets amidst all the prevailing economic and geopolitical uncertainties.
Gold is the classic safe haven.
It is. And Goldman Sachs even raised their gold price target for 2025.
So they're bullish on gold.
They are. And then we also can't forget about CoreWeave, the AI leasing company.
Oh, yeah. What happened with them?
Their IPO reportedly priced below expectations.
Interesting.
It is. And this could be another sign of perhaps cooling enthusiasm in the AI sector, or simply a reflection of broader market volatility impacting new listings.
It's hard to say for sure.
It is. And finally, Pictet Asset Management is reducing its overweight position in Turkish corporate bonds due to recent political unrest and concerns about currency depreciation.
So geopolitical risk is rearing its head.
It is. And this just highlights how these events can also play a significant role in investment decisions.
Absolutely.
So as we wrap up this deep dive, the key interconnected themes really stand out right. We have the uncertainty surrounding potential tariffs, creating a significant economic headwind.
Making it tough for businesses to plan for the future.
Exactly. And then we have inflation data continuing to heavily influence expectations for central bank interest rate policies.
Both in the U.S. and Europe.
And then finally, we're seeing some notable shifts in investor sentiment reflected in lower stock correlations and a rotation from growth to value stocks.
It's a lot to keep track of.
It is. And it all underscores the importance of staying informed.
And understanding how these various factors interact.
Exactly. So keep your eyes peeled and your ears open. All right, well, that brings us to the end of our deep dive into this week's major financial headlines. We'll see you all Monday morning with new headlines from major financial magazines.